Bill Spiropoulos, CEO of Core State Capital Advisors, Greg Womack, fund manager of Womack Advisors, and Rich Regan, founder of ProTradingCourse.com. Guys, this is feeling like one of those frightening Fridays that we lived through in the United States. Europe is going through it right now. Paul Volcker says that we could be on the verge of the disintegration of the euro. Does Europe have the potential to derail all of the headway we have made here in the United States? Greg, what do you think?
It has that possibility. I mean, we're seeing the volatility over the last week or so, and so it is the possibility there. No one knows for sure what's going to happen. Therefore, I think it's important for people to diversify and protect.
Rich Regan, I got to assume this is one of those weekends you don't necessarily go into long. What do you do as you go into a weekend knowing that they've got to be scrambling the jets over there?
Well, I think that the destabilization of the euro and the eurozone is very dangerous for everybody. There's no winners in this at all. It can only be the potential start of another global crisis. So going into this weekend, there's certainly concerns about being long stocks. I'd say a short euro is probably a good hedge if you're long stocks right now going into the weekend.
Everybody's in that trade.
Everybody's in that trade. That's the problem, isn't it?
Yes, it is. I mean, everybody is short the euro, but I'm not one to try to pick the bottom or pick the tops. The momentum is the downside. There's no clear-cut fix right now. This rescue package that came out a week ago didn't have near the impact people thought it would, so things still look bad for the euro. No reason not to be short it, especially if you're long stock.
Bill Spiropoulos, we just got a flash that the investment-grade credit default swaps here in the United States widened out 9% this morning. So it's all well and fine and good to say look for safe havens, but if investment-grade corporate paper in the United States is getting hit, what does that tell you about where you should put your money?
Under your mattress? You know, during tough times when you have people being hysterical, that's when using brain power and discipline really matters. And I think that this time's no exception. You have to stick to your strategy, buy your favorites, use a long-short approach. And it better be more than just equity. You need managed futures, currencies, the whole gamut.
Who's being hysterical, Bill?
I hear something in the background, lots of yelling. Somebody is.
So, but you're talking participants in the market. It seems to me you suggest they're overreacting to what is happening in Europe.
I think so. I mean, the euro, the world did fine when you had pound sterling, you had French franc. If it goes back to that, it goes back to that. I don't think that's going to happen. I think we're going to get through this.
Hey, Greg, you had said that there is the threat or the possibility of contagion, but how much of that is just investor fear because we're waiting for another big downfall, and how much is real? It just seems like we're able to offset a dip in one region with growth in other regions.
Exactly. I don't think this is the end of the world like it was in '08. It's just a lot of volatility, a lot of fear and uncertainty.
That's right.
And so therefore we've just got to protect. You've got to diversify. Like the gentleman just said, you have to have a multi-approach. Diversification doesn't mean 10 different stocks in 10 different sectors. It means non-correlated assets such as managed futures.
What does that mean, non-correlated assets? Explain that, because that's a phrase that we hear sometimes, but I don't think the novice viewer necessarily understands what does that mean.
Well, you look at the historical returns of a non-correlated asset. It means it's not correlated how the stock market moves. For example, managed futures last year, on average, around 20%. Excuse me, in 2008, around 20% return when the market was down 38%. Gold was up 6%. And we also do a lot of, in our shop, a lot of non-traded REITs, real estate trusts, where we're seeing 7% cash flows. There's risk in all these, but I think people Main Street America needs to say, okay, I need to get back to diversification. Volatility's picking up. I got to be in the markets because I can't make money outside of it.
But Rich Regan, we're going into a weekend where the European stock markets lost considerable percentage points today. You have the euro testing new 18-month lows. There's active talk that they're going to need a debt restructuring in Europe. The ECB was in buying private sector debt earlier this week. It has the feeling of the fear factor that we felt in '08, perhaps not quite to that extent. But what do you do going into this particular weekend? I know you said short the euro, but for those who are uncomfortable with that trade, what else can you do?
That space is crowded.
When you look at the stocks, one of the primary things in the stocks, the S&P 500, approximately 25% of the stocks of that 500 have huge exposure to the Eurozone, I would certainly roll out of those stocks and into some that are more internally based, like some of the Dow stocks you see higher today, like Walmart and even Verizon. Those might be better options if you want to just stay in the stocks and not hedge using the currency.
And by the way, those are the only two that are higher. 28 out of 30 or 29 out of 30 Dow components are lower today. Bill, what about the big caps that do have a lot of exposure to Europe? Should you be worried about the earnings flow from there?
No, I don't think so. I mean, there may be some bumping and grinding, but these companies are going to continue to make money and be profitable. You know, you look back at the 1982 to 1988 period, and it was king dollar. Those companies made plenty of money. And I think this currency thing is getting to be a little too exaggerated. It's too easy, dollar up, stocks down. That's going to decouple, and you're going to see some changes here, and it's going to be all about growth and earnings and economic activity, and we lead in that category.
Gentlemen, thank you.
He is so zen, Mr. Stroh.
Yes, he is.
Well, you have to be at a time of spreading panic like this. I think this is overdone, and we got to take a breath. Actually, for most individual investors, you should do nothing heading into this weekend. Do nothing. The thought that you juggle stuff all over the place because, oh my gosh, people in Europe are scared is just, to me, not
And the
smart.
point of being diversified is you should have been diversified months and months and years ago. Now is not the time to diversify.
But it didn't work.
Right.
It didn't work in 08.
Yeah.
It didn't work.
But don't we think that when we look back on 08, we were a little too scared, a little more scared than we should have been? Stocks up 70% since then. I'm thinking...